Hello everyone. Today I'm going to be discussing about what is tax cuts. During recessions, the government will occasionally offer a tax cut as an economic stimulus. In rough terms, a tax cut of $1 trillion over 10 years will give back an amount equal to about 1% of consumer spending annually over that period. Now the first question about tax cuts is exactly how do they stimulate the economy? This is not a stupid question. Remember, if the government gives us a tax cut, they will still have to make up the budget shortfall somehow, chiefly by selling more bonds to American citizens, who happens to be the same people getting the tax cut, or the foreigners who will raise the money by selling us more of their goods and service or buying less of ours. In other words, government spending will keep sucking money out of private sectors. Only the payment method will be different. Yet, most of the economists seems to agree that tax cuts really do provide a stimulate. The real reason may be that they provide flexibility. People who want to consume more can use their tax cut for that purpose. People who want to save more can use theirs to buy up the new government bonds. This is a perfect scenario during our recessions, when prior over-investment has resulted in bloated inventory levels and poor private investment opportunities. Okay, so the second topic I'm going to talk about is about GDP. The gross domestic product is one of the primary indicators used to gauge the health of the country's economy. It represents the total dollar value of our goods and services produced over a specific time period. You can think of it as the size of the economy. Usually GDP is expressed as a comparison to the previous quarter or year. For example, if the year-to-year GDP is up 3%, this is thought to mean that the economy has grown by 3% over the last year. Measuring the GDP is complicated, which is why we left it for the economists. But at its most basic, the calculation can be done in one of the two ways, either by adding up what everyone earned in a year, or known as the income approach, or by adding up what everyone spent, or known as Expenditure Method. Logically, both measures should arrive roughly at the same total. The income approach, which is sometimes referred to as GDP, is calculated by adding up total compensation to employees, gross profits for incorporate and non-incorporate firms, and taxes less any subsidized. The expenditure method is the more common approach, is calculated by adding total consumption, investment, government spending, and net exports. As one can imagine, economic production and growth, what GDP represents, has a large impact on nearly everyone within the economy. For example, when the economy is healthy, you will typically see low unemployment and wage increases as a business demand labor to meet the growing economy. A significant change in GDP, whether up or down, usually has a significant effect on the stock market. It's not hard to understand why. A bad economy usually means lower profit for companies, which in turn means lower stock price. Investors really worry about negative GDP growth, which is one of the factors economists use to determine whether an economy is in a recession. For this reason, GDP represents the total value of all goods and services produced in an economy. Thank you.